Hey guys, welcome back to the channel. In my previous video, I went over the process for a backdoor Roth IRA. If you're not familiar with that, you might want to watch that video first. But in this video, we're going to go over what is the mega backdoor Roth IRA. This really is some next level finance stuff, so we're going to go over what is it and who is this for. And who this is for, really, it's caught on in popularity in the FIRE community, the financially independent retire early. So this is for people who are earning really high incomes and living really below their means. They're trying to spend as little as possible and get as much money in tax advantage accounts as possible so that they can quit their jobs and retire early. Definitely there are doctors and lawyers who are doing this, but mostly it's high income earners at Fortune 500 companies like Facebook or Google. Now, if you're unfamiliar with the different kinds of accounts and how they're treated for tax purposes, let's do a quick recap. For the retirement accounts, there is the 401k, and this is through your employer. These are payroll deductions into your account. And then there's an IRA. This is what you set up with a private investment bank like Fidelity, Vanguard, Schwab. Now, Roth is how the money in the account is treated for tax purposes. On the Roth side, you're not getting a tax deduction, no tax savings this year. However, tax-free growth and then tax-free withdrawals. For traditional or pre-tax IRAs, 401ks, you're getting a tax deduction this year. You're getting a savings this year, tax-free growth. However, you've agreed to pay ordinary income tax on this money in the future when you go to withdraw. Amongst all your IRAs, your contribution limit is $6,000 a year. And amongst all your 401ks, your total contribution limit is $19,500. Or is it? So let's go over all the tools available to you as someone trying to put as much money in tax advantage accounts as possible. First up, of course, is your traditional or Roth 401k. You can contribute up to $19,500, and your employer will match a certain amount. Maybe your employer doesn't offer a match, maybe it's 5%, maybe it's capped at a certain amount, so this can vary person to person. Next up, you have your personal Roth IRA. And if you're married, you have a spouse, then he or she will also have an additional $6,000 they can put in their Roth IRA. Then you also have the HSA. And this is actually something that's really important because you're not going to qualify for Medicare until you're 65. And if you leave your employer, you might not be able to find a good, affordable health insurance plan. So if you sign up for a plan with a high deductible, you are then qualified for getting an HSA. You and your spouse can put up to $3,550. And HSAs are fantastic because they're actually triple advantage tax deferred accounts. So definitely a great resource available to you. Now, the mega backdoor Roth IRA is potentially worth up to $37,500 a year per person. What the heck? How does this even work? This is more money than basically all the others combined that can potentially go into a tax-advantaged retirement account. And what's happening here and what you're going to do is you're going to make a contribution through your employer's 401k plan and then roll it into your personal Roth IRA. Let's talk about that. Now, unfortunately, not everyone is eligible to do this. You must have a job that offers a 401k plan, and you must be able to make after-tax contributions to a non-Roth 401k. What is all that? Well, not all company 401ks will allow you to do this. You can ask your own company, is this something that you can do after-tax contributions to your traditional pre-tax 401k plan? And additionally, your company's 401k plan must allow in-service distributions or in-plan conversions in the same year that you made the contribution. Now, if you're a small business owner, you can actually go shop around and find a 401k plan that specifically will allow you to do this. Maybe the big ones like Fidelity and Vanguard don't, but there definitely are companies that you can partner with that do allow after-tax contributions to a traditional 401k and allow for in-service distributions, conversions, rollovers to an IRA in the same year you made the contribution. Now I know there's people watching this video and they're confused. They were so confident that the contribution limit for a 401k was $19,500 for the year 2020. When you Google it, 401k contribution limits 2020, it gives you the number $19,500. However, if you Google 401k aggregate contribution limits 2020, you get this crazy number, $57,000. Obviously, if you're over the age of 50, you can do catch-up or additional contributions, but most people watching this video, it's either 100% of the participant's compensation, their entire salary, or up to $57,000 total. So let's rewind and just go over the concept of a traditional and a Roth 401k plan. So let's say you wanted to put $1,300 into your traditional 401k. This is pre-tax money. You're not paying federal income tax on this money this year, so you're getting a tax savings. Let's say it grows 10x, becomes worth $13,000. You then pay ordinary income tax on your distributions in the future, leaving you with $10,000 after tax. With a Roth, you're not getting a tax deduction this year. So potentially, you're trying to anticipate what your tax obligation will be, so you're contributing less because you're paying income tax on your contributions this year. Let's say in the future it grows 10x. In the Roth account, in theory, you would have less money because you were taxed when you made the contribution. However, tax-free withdrawals, in the end, this should be net the same amount if your marginal tax rate is the same, both when you put the money in and you take the money out. Now, the after-tax non-Roth contributions that you make to your 401k, you're not getting a tax savings when you make the contribution. You're still agreeing to pay your federal income tax on contributions. It then does grow tax-free year to year in the account, which is nice. However, when you go to make withdrawals, once again, you're going to be hit with your ordinary marginal tax rate, paying taxes a second time. So after-tax non-Roth 401k contributions are inferior in every way to traditional 401ks, Roth 401ks, and I would even argue it's inferior to ordinary brokerage accounts. If I just open an ordinary brokerage account and put in after-tax money, I get favorable long-term capital gains tax rates when I pull the money out if I held it longer than a year. Long-term capital gains for most people is 15%, potentially even 0% if it's under a certain amount. So paying your marginal tax rate when you go to withdraw, I would argue that this is a bad deal. And I think the IRS knew this, so the IRS made this law a long time ago saying, okay, if you want to put more money into your 401k plan and not get tax savings and agree to pay income tax, that's actually better for us in the long run than people paying long-term capital gains. However, a couple years ago, the law changed again, and let me explain what people are now able to do. So let's conceptualize this. Total 401k contributions in a year, $57,000. Now you can max out with your own contributions, $19,500. Let's just make up a number for the employer match. So your employer is going to match $5,500. So you're now at a total amount of $25,000. And what is the after-tax non-Roth contribution that you can make? It's now $32,000. You can put in an additional $32,000 into your traditional 401k. But of course, you're a high income earner and you're doing the backdoor Roth IRA method, so you've already maxed out your ordinary Roth IRA $6,000. What you're going to do is you're going to do an in-service distribution, an in-service rollover, and you're going to move that after-tax non-Roth money, this is legal, into your Roth IRA in the same year. And this bypasses your contribution limit of $6,000 for your Roth IRA. So in a single year, you just contributed $38,000 to your Roth IRA. And the federal government thought they were going to get their money. They thought that when you made this contribution to your 401k, you were going to be paying your marginal tax rate when you went to withdraw it in the future. However, because they changed the law and they allowed for these in-service distributions, people are now rolling that money into their Roth IRA, they're now getting tax-free growth and they're getting tax-free withdrawals. Anything that this contribution makes, now that it's in the Roth IRA, is going to give you tax-free earnings and tax-free withdrawals for the rest of your life. And it really starts getting silly when you factor in your spouse. If you and your spouse are both high income earners, maybe you both work at Google or Facebook, your spouse can also contribute $6,000 and can also do the mega backdoor Roth IRA for an additional $32,000. So the tax-deferred savings really adds up pretty fast if you can even if you only do this a couple years with your current job. Okay, it's at this point in the video that I have to tell you that I am not a CPA, I am not a financial advisor. If you're making this much money where you are even considering doing this, hire a tax professional to help you with all the paperwork and guide you through the process. Do not try and TurboTax this yourself. But if done correctly, holy cow, the money that you are saving in tax-deferred, tax-advantaged accounts is phenomenal. If you and your spouse are high income earners and you're working together, you know, 2 401k plans, 2 Roth IRAs, 2 HSAs, and 2 people doing the mega backdoor Roth plan. Now, obviously, that's a very large number, and potentially, if you only did 5 or 10,000 extra, that's once again more money going into your Roth IRA. But potentially, the cap as of this year, $122,100 going into tax-deferred, tax-advantaged accounts. Holy cow. And there you have it, guys. That is the mega backdoor Roth IRA explained. Once again, this is some next level finance stuff that doesn't apply to a lot of people, but for everyone else watching, I hope you found it interesting. If you like this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I post a lot about finance and investing topics. And if you have any questions or comments, I will do my best to help you. But once again, I am not a CPA, I am not a financial advisor. And until the next video, guys, take care.